Hi, everyone, and thank you for joining us today for our training presentation on selling the HECM line of credit growth feature. This is a CRMP approved course, so if you are looking for credit towards your designation, please let us know in the Q&A pod so that I can make sure that you get your certificate within 24 hours and that I report your credit to NORMLA. My name is Chris Danish from FAR's Learning and Development Division, and I will be your producer for today's training. I'd like to introduce you to your instructor today. We have Barb Crippo. Barb is our National Wholesale Sales Trainer here at FAR. She has over 20 years experience in the mortgage industry, with 15 of those in reverse. She has been a branch manager, a trainer, a coach, a CRMP, and she is a master trainer. We hope you enjoyed today's call. Barb?
Thanks, Chris. And thank you everyone for being here. I just want to say this is a great class for you to take, especially right now. This is a CRMP class, so I know you all have experience with reverse mortgages. And as we see interest rates climb, one of the benefits that the reverse mortgage has is that our line of credit is going to grow at the same rate of interest charge plus that 0.5%. And right now, that's a substantial number. So it's a great time for you all to be taking this course, and I appreciate you being here with us today. For a while now, the industry has been trying to get better at understanding the role of financial planners and advisors, because we know that line of credit that comes with the reverse mortgage is an outstanding retirement planning solution. But do we know how to sell the line of credit feature properly and compliantly? Very important. So that's the focus of today's call, understanding and selling the line of credit features so that retirees can have flexibility and financial planning advantages during retirement. So what we're going to do today is discuss the HECM ARM payout plans, the HECM line of credit features and benefits, the HECM line of credit growth, the mathematical explanation of how that grows, and the compliant explanation, how to explain it compliantly. So one of the advantages of the adjustable rate HECM is, of course, the varied payout plans. They have options. The adjustable rate HECM allows funds to be used in a variety of ways. Now, the most popular option is the line of credit. Now, this lets the borrower draw out funds as they need them and is our primary focus on today's call. Of course, if the borrower wants monthly payments, they can receive a 10-year or a term payment, or any combination of these. Now, when we use the line of credit and the monthly payments together, we call these modified tenures or modified terms. In addition, of course, a lump sum is also an option. Now, it's been said that the HECM line of credit is the basis of all HECM financial planning. Some key selling points of the line of credit are that the unused portion of the line of credit grows tax-free, very beneficial to those financial planners who are looking at seniors in a situation that they are paying income taxes. Draws from the line of credit are not considered income. They are considered distributions from their home equity. The undrawn line of credit does not accrue interest or mortgage insurance that impacts the borrower's loan balance. The available line of credit can be converted into cash at any time, with, of course, some restrictions during the first year. You know that we have those first year limitations. I'm not talking to newbies. You guys know this. The line of credit is secure. It can't be frozen, reduced, or eliminated if the property value drops. Now, we've seen a lot of property appreciation, and it could happen. It happened a few years ago. Prices of homes could decline as interest rates climb. One of the great features of the reverse mortgage HECM line of credit is that it cannot be frozen, reduced, or eliminated if property values drop. We saw that happen a few years ago with regular lines of credit. We do not have that worry here. The line of credit can be used as a liquid emergency fund, as lenders have 5 days to deposit requested funds. And quite frankly, if you've got a borrower who is savvy and they fax that request in or email that request in, they've got direct deposit, they're going to get those funds very, very quickly. The other thing that I always told my borrowers is if you have an emergency, the car breaks down, you put it on a credit card. As soon as you get home, you request that money. You'll have those funds before you even get the credit card bill. And of course, most credit cards, you don't pay interest for the first 30 days. So our process is really quick at getting those funds into the borrower's hands. But if they have an emergency today, they can use a credit card and pay it off with the line of credit funds. The line of credit can be used as a form of insurance against longevity and market cycles. The line of credit diversifies the home equity investment as it grows, regardless of the home value. Okay, very important. That line of credit is not tied to the home value as it grows. The growth, it's going to grow regardless of whether the home value increases or decreases. And since we've had all of this appreciation, we're not sure what the future holds. Property values could start declining. Who knows? They could continue to rise. It's anybody's guess at this point. But if it does, if their property values do decrease, that will not affect the growth of the line of credit. And of course, the line of credit increases every time prepayments are made. So we all know that you don't have to make any payments back on the reverse mortgage, but if they have an adjustable rate, making payments back will increase their line of credit that's available to them dollar for dollar. So it's a great strategy. So one of the first reactions is, why not just get a home equity line of credit? So a home equity line of credit, of course, they're cheaper. The closing costs are cheaper, but the advantages of the HECM become clear when you compare it to a traditional home equity line of credit or HELOC. When you compare the HECM line of credit with a traditional home equity line of credit, the HECM line of credit has no monthly repayment required. So there is no minimum monthly payment required. Typically, a traditional line of credit is going to require at least an interest-only payment. And line of credits differ per bank. Some of them are 1% of the mortgage balance. Some of them are 1.5% of the balance. It does vary by bank. However, there is almost always at least an interest-only payment that's due on a regular home equity line of credit. A HECM line of credit has no term limits. As long as the residency and maintenance requirements are met, traditional line of credits have the reverse has no term limit. So it will continue for as long as the borrower lives in that home and they're keeping the loan in good standings. But with a traditional line of credit, those typically have a term. Maybe it's 10 or 15 years. Again, it depends on the bank. And then at the end of that 10 or 15-year draw period, they tend to have a balloon payment or have to be recast into a fully amortizing loan for 10 to 15 years. And again, you may know a credit union or a bank that has some different things for their line of credit, different requirements. This is just in general, but it does vary by bank. But in general, they can typically draw on them for 10 to 15 years, and then they either balloon or fully amortize at that point, of course, requiring a higher payment, or a balloon would require them to do something else. A HECM line of credit cannot be canceled as long as the residency and maintenance requirements are met. Regardless of what happens to the value of the home, that line of credit is going to be in place for your borrower if they do the reverse mortgage line of credit. Traditional line of credits can be canceled, and we have seen that happen in the past. Not to say that it's going to happen again, but you never know. So this is another safety net that we have. And I believe we've got a video.
Meet Jerry and Catherine. They are both in their late 60s. Catherine purchased long-term care insurance years ago, but Jerry's health issues made a policy out of reach for him. Now, as they prepare to fully retire, they meet with their financial advisor, Don, who cautions them about possible care expenditures as they age. Jerry is concerned that he cannot qualify for a long-term care insurance policy and relays this to Don, who suggests he speak with a reverse mortgage specialist to see if a reverse mortgage line of credit might be a good option to self-insure and as an added safety net. Jerry and Catherine set up a meeting with Elaine, a reverse mortgage loan officer, and she explains that since Jerry and Catherine have no outstanding mortgage, they could establish a line of credit for the entire amount of the principal limit. She reviews the growth feature of the line of credit, and Jerry and Catherine are pleased with her suggestion. Jerry is relieved to know that the line of credit will continue to grow, providing access to more funds for care should he need it in the future. Catherine admitted that this has been weighing on her mind, and the credit line growth feature is an added bonus she had never heard of before.
So a great use for the line of credit. In his situation, he was not able to qualify for long-term care. Of course, as many of us know, sometimes you can pay into long-term care and never use it. And therefore that money's just gone. Whereas the standby line of credit, in case he has needs in the future, he would be able to use those funds to pay for any long-term care needs that he would have. But if he doesn't have those long-term care needs, then those funds could be used for other things versus buying a long-term care policy and then that money just being out the door. And I know there are different long-term care policies out there. I know some of them have cash value, some are attached to life insurance. So there are cases where it makes sense, but just one more situation where the home equity line of credit with the reverse mortgage might work out better for him.
Time for a brain train. HECM ARM payout plans include A. Line of credit, 10-year payment, and lump sum. B. Line of credit, term payment, and lump sum. C. Line of credit, term or 10-year payment, lump sum, or a combination. D. Term payment and lump sum.
Go ahead and post your answer in the Q&A pod. Let's see who is paying attention. Awesome, Barb. We got a good group today. Awesome. Well, thank you for answering. And yes, the answer is C. It's for the line of credit, term 10-year payment, lump sum, or a combo. Thank you.
Wonderful. So what makes the line of credit grow? There's actually two functions on the HECM ARM that create growth in the line of credit. The first one is what we call organic growth. So that's pretty much a term that we use. I think everybody's adopted. It's not a real term, but that's what we call it. What that means is basically it happens naturally. So if you do nothing, and the reason it happens is because the borrower's principal limit continues to grow at the same growth rate as the loan balance does, which is their current interest rate plus 0.5%. So any funds available are always going to grow at their current interest rate plus 0.5%. That's the organic growth. The second way that the line of credit can grow is by the borrower making voluntary payments. We call them prepayments. And what they're doing when they make prepayments is they're reducing their loan balance. By reducing that loan balance, the outstanding balance versus the principal limit, the borrower increases the funds available in their line of credit even more. So that is a strategy that some people do use. So for example, if a borrower makes a $5,000 prepayment, the loan balance is going to decrease by $5,000. And think of it like a teeter-totter. You've got a teeter-totter or two buckets that are, being weighed against each other. As soon as that loan balance decreases by $5,000, then the available line of credit is going to increase by $5,000.
Meet Ken and Liz. Ken is 63 and Liz is 64. They were planning to retire before they turned 70 and had been saving what they could to provide for a comfortable retirement. After a recent meeting with their financial advisor, they determined that they would need to work even beyond age 70. They wanted a better plan. During Ken's next weekly golf outing, he asked his friend Ron, who was happily retired, if he had any tips to share. Ron explained that he and his wife had taken out a reverse mortgage that provided them a line of credit with funds that would be available to them in the future
should they need them. Ron reasoned that one of he and his wife's greatest investments was their home, so why not let that investment work for them? Ron further explained that his favorite part of the reverse mortgage was the line of credit and the growth feature that accompanied it. He said the line of credit had a growth rate that over the years would make even more funds available when he and his wife needed or wanted them. Now, Ken was intrigued and asked Ron if he could recommend anyone to talk to see if it might be a good solution for he and Liz. Ron referred Ken to Sam, the same loan officer he and his wife used. Later that week, Ken and Liz met with Sam. He took the time to answer their questions. After they provided some basic information to Sam, they received a quote for their very own reverse mortgage, which included an amortization schedule that they took to their financial advisor. They learned that using just the growth from the line of credit to supplement their retirement savings and investments would make a big difference. In addition, the line of credit was there as a safety net should a want or need ever arise. They met again with Sam to begin the reverse mortgage process. The line of credit and the growth it provides will help them realize their dreams of retirement before they turn 70.
So just a powerful video, and it speaks to the fact that sometimes, because they had met with their financial planner, and sometimes the financial planner doesn't consider home equity when they're looking at their retirement. They should, absolutely. Financial planners should look at this, but that's part of our job to go out and educate financial planners so that when they went to his office for the first time and he had to give the bad news that they had to work past age 70, the financial planner, it would have been much more powerful if the financial planner would have said, hey, have you thought about a reverse mortgage? This may be an option for you. Now, they wound up finding out through a friend, which worked, and they took it back to their financial planner, and they figured out that it would work and they'd be able to retire sooner. But it is part of our job to educate those financial planners as much as we can to make sure that they are considering home equity in that retirement plan. Okay, so this is a nice illustration of organic growth. Now, this is, of course, using our Illustrator tool. Some of you may recognize that. And this assumes a home value of $450,000 and a constant line of credit growth of 4.99%. Now, I will tell you, we're higher than that right now. So as you can see, that major slope up, we're going from 200,000 to pushing $1 million. Can you imagine? I think our expected rate, I just quoted one at like 6%. So could you imagine that growing at a much higher rate? Because currently our rate is substantially higher than the 4.99 that is on this graph.
This is Joyce. Joyce is 73 years old and is a widow. She is very excited that her grandson, Bobby, has been accepted to go to college. He will be the first one in the family to get a college degree. She would like to help him with college and decides to call her financial planner to see if there is any way that she can get extra money to help Bobby.
My Bobby got accepted into a prestigious university. Not only that, but he impressed them so much that they're giving him a substantial scholarship. He is such a smart boy. I am just so proud of him.
Wow, that's great news. I remember you said he will be the first in your family to get a college degree. And I know you've been dreaming that he would get his chance. Now his hard work has paid off. Congratulations to Bobby.
Hard work is right. You know, he has to study twice as hard to get the same grades that seem to come so easily to other kids. You know, his scholarship is tied to his GPA, and if that slips, I'm afraid they might pull his scholarship. I wanted to talk about a way for me to help him with his personal expenses while he's in college so that he doesn't have to work. I want him to be able to spend more time on his studies. I'd love to help him, but I know you already told me that I shouldn't increase my withdrawals. I know that I'm at risk of running out of money.
Joyce, I'm sorry. I know you really want to help him. However, I cannot advise you to take any more funds out of your investments at this time. Your future needs could make your expenses increase as you age. And if you withdraw additional funds, you might put yourself at greater risk. We've already discussed that if you live to be 97 like your mom did, you'll run out of money by the time you're at 95.
I understand. And I know that you're only telling me what I need to hear. I love my grandson more than anything in this world, and I would love to see him walk across that stage and accept his college degree. But I know that I can't put myself at risk to do it. As you know, I don't want to have to depend on anyone else. I want to take care of myself, but there's got to be a way.
Well, how much money do you think he needs?
Well, right now he brings home about $100 a week from his part-time job. So somewhere between $400 and $500 a month. Oh, if only I were rich.
Yeah, right. Well, let me think about this. We've talked about the fact that you may need a reverse mortgage at some point in the future.
Yes.
Well, how would you feel if I put in a call to a reverse mortgage specialist that I know and trust so that they can run some numbers? If we can pay for Bobby's college out of the equity in your home, is that something you'd like to learn more about?
Well, I think so, but you said I might need that to take care of myself someday.
That's true, and that hasn't changed. I think we might just have a way to do everything you want to do.
Oh my goodness. I could pay for Bobby's college and still make sure that I have what I need financially, even if I live longer than my mother did?
I believe so, but I'm not the professional when it comes to reverse mortgages. I'm going to call a reverse mortgage specialist that I work with from time to time and explain what you want to accomplish. I'll have him run some numbers, and from those numbers, I'll be able to advise you better.
That sounds great. I would love for you to do that for me, and please let me know what you find out. Thank you so much. I really hope this works out, and please let me know as soon as you can.
Joyce's financial planner spoke with their trusted reverse mortgage specialist. Joyce's home is worth $350,000 and she has no mortgage. She is 73 years old and using an expected rate of 3.56%. So after closing costs, Joyce will have a line of credit of over $179,000. Assuming the same growth rate of 3.56%, she will have growth of over $7,400 in the first year, which is way more than she is looking for to help her grandson. Assuming she takes the full amount of the growth every year and no more or less, she will have the original credit line in the amount of $179,181.55 when she needs it. If she only takes the growth for the first 4 years that she needs to pay for Bobby's college, the credit line will grow beyond the original amount. That would leave her with a line of credit of about $300,000 when she's 95 years old.
So another great example, and that one, she was using just the line of credit growth to pay for her grandson's college, which left the original line of credit intact to continue to grow. And as you saw, if she only took it for 4 years while her grandson would be in college, then that growth not taking it is just going to accumulate. And when she's out of money at 95 and needs to start drawing from it, it's increased to $300,000. So a great use of the line of credit. So the skeptic borrower or financial planner might want to know, where does it say that? And the easiest way to document the line of credit growth is to explain that the federally regulated disclosures say it. That includes both the amortization schedule and the loan comparison form. So you can point to those forms. I hate to disappoint you, but there's no federal statute that actually outlines organic growth in plain English. But now, mind you, I didn't write these documents, but the best I can do is show you the most commonly quoted section of the Code of Federal Regulations, CFR. I'm sorry, it's 24 CFR 206.25D. And that states that the line of credit amount increases at the same rate as the total principal limit increases. But then you need to know how the principal limit grows. Well, it grows monthly at a rate that's equal to 1/12 of the mortgage interest rate in effect at that time plus 1/12 of the mortgage insurance premium rate, which is currently 0.5%. However, the adjustable loan agreement also references the line of credit growth on page 2 of the HECM ARM loan agreement. It states that the principal limit increases each month for the life of the loan at a rate supplied by the secretary that is listed in the payment plan. So then you need to go to the payments found in Exhibit 1 of the closing documents, and then you'd still need to add the lender margin. You'd need to add the index, and you'd need to add the 0.5%. So that would identify the growth rate. Again, it's not clearly stated, but it is there. Lastly, the HECM handbook is very specific in Appendix 22 regarding how the net principal limit is calculated and how the available line of credit is calculated. But I'm not going to make you do that math in this lesson today. So we'll just go ahead and move on. So most homeowners don't make prepayments towards their reverse mortgage loan balance. They don't have to. That's one of the features of our loans, is that they don't have to make payments back. However, sometimes the prepayment growth is a hidden advantage for the future retirement security of our borrowers. So if you have a younger HECM borrower that's still working, or they have the ability to make any payments at all, then this is a no-brainer. Reduce the loan balance and boost the line of credit at the same time. That's going to save them money on interest charged and give them more of a safety net in the future. The illustration you see on your screen there assumes the same home value and growth rate, but the borrower makes a one-time payment of $50,000 in year 10. So maybe they had a rich aunt or a rich uncle that died, or maybe they fully retired and had a windfall. For whatever reason, they made a one-time payment in year 10 of $50,000. At the time of the prepayment, the loan balance drops by $50,000 and the line of credit increases by $50,000. Now, some have debated whether it's a dollar for dollar increase in the line of credit, and the answer is that it should be. That is the way that servicers are supposed to post their prepayments. But if you have a borrower that's not rewarded properly, let me know so that we can look into it and reach out to the servicer. The servicer has what they call waterfalls, and I think that a lot of the representatives that answer the phone don't fully understand that regardless of what bucket got paid off first, ultimately the available principal limit or line of credit should be the difference between the principal limit at that time and the loan balance owed. So a lot of the servicers do get it wrong. But if you do find that, please reach out to us so we can have that investigated and corrected. I don't think it's happening as much as it used to, but it used to happen quite a bit. In addition to the formulas for calculating the net principal limit, there are 3 references that we can use to document the line of credit through prepayment. So HUD-HECM handbook states that a borrower may choose to make a partial prepayment to set up or increase a line of credit without altering existing monthly payments. By reducing outstanding balance, the borrower increases the net principal limit. So that is the key there. By reducing the outstanding balance, the borrower increases the net principal limit. All or part of the increase in the net principal limit may be set aside for a line of credit. Keep in mind that HUD uses net principal limit instead of line of credit because the net principal limit could be allocated for monthly, term, or 10-year payments instead of a line of credit. So that's why they use that verbiage. The adjustable rate note also has something to say about it. A borrower may specify whether a prepayment is to be credited to that portion of the principal balance representing monthly payments or the line of credit. If the borrower does not designate which portion of the principal balance is to be prepaid, then the lender shall apply any partial prepayments to an existing line of credit or create a new line of credit. So if you have a borrower who's receiving monthly payments, they do have the option to make a payment back and then increase their monthly payments. If they do not specify, it will be credited to the line of credit. You'll see that line of credit increase. That's always the default if the borrower does not specify. Lastly, HUD's servicing handbook addresses it as well. The mortgagor may choose to make a partial prepayment because his or her financial circumstances have improved and he or she wishes to preserve more of the equity in the property. A mortgagor may choose to make a partial prepayment to set up or increase a line of credit without altering existing monthly payments. By reducing the outstanding balance, the mortgagor increases the net principal limit. All or part of the increase in the net principal limit may be set aside for a line of credit.
Meet Bob and Amy. Bob is 65 and Amy is 63. They've been discussing retirement with their friends, some of whom are already retired. Bob is a consultant in the food services industry, and Amy works for a small nonprofit in their hometown of Des Moines, Iowa. Neither Bob nor Amy have pension plans, but they've saved what they consider to be a fairly sufficient amount in their 401k plans. Well, as much as they could while raising and putting 3 children through college. However, in talking with their friends, they're quickly realizing that they did not plan for the amount of medical expenses they might incur. Their neighbor Janice needed back surgery last year, and one of Bob's poker buddies had a stroke 3 months ago. This has raised some real concerns for Bob and Amy, and they weren't sure where to turn until they attended a talk at their local community college. This talk focused on the use of home equity in retirement. They learned that they could take out a reverse mortgage, which would pay off their current mortgage, allowing them to use the additional cash flow for savings. But what really excited them was the option of the line of credit and the growth feature it offered. Bob reasoned that this could bridge the gap, and he and Amy immediately scheduled an appointment to meet with the loan officer, Michael, who held the presentation. As it turned out, it was a pivotal meeting in their retirement planning. Michael shared the many benefits of the HECM and HomeSafe lines of credit, including the organic growth. But what got Bob and Amy's attention the most was the prepayment strategy Michael talked about. Bob reasoned that while he and Amy were still working, they could make prepayments in the amount of their choosing and further increase the available line of credit. With both the organic and prepayment growth strategies, the line of credit would bring a sense of relief that Bob and Amy are now confident that they can move forward with planning their retirement in the next few years.
So another great example, just again, making those payments back so that the line of credit grows more and there are more funds available in the future. So another reason we know that prepayments increase the line of credit is because we can prove it mathematically. Assuming there are no set-asides, the formula for calculating a borrower's available line of credit is rather simple. The line of credit equals the CPL minus the UPB. So basically, if you have a $200,000 current principal limit, a $50,000 outstanding balance or unpaid balance, UPB, unpaid balance there in red of $50,000, then your line of credit is going to equal $150,000. So the cool thing about this formula is that all parts of this equation grow at the same rate, which is the note rate plus 0.5%. So basically your CPL is growing at the note rate plus 0.5%. Your UPB, the outstanding balance, is growing at the note rate plus 0.5%, and your available line of credit is growing at the note rate plus 0.5%. So if you don't like math, here's another way to explain it using the seesaw, which I referenced earlier, or a teeter-totter. I'm from where I'm from, we call it a teeter-totter. Some people call it a seesaw, but it's what the kids used to play on. You put one on each end. If the borrower qualifies for $200,000 in principal limit and they have borrowed $50,000, that leaves $150,000 in the line of credit that's available. So if I was on camera, you'd see me using my arms doing like a scale. But if you borrow the remaining $150,000, the loan balance would instantly jump up to $200,000 and the line of credit would go to zero. Does everybody understand how that works? Now, the reverse is also true. So if the borrower makes a prepayment, the UPB gets lighter. Okay, the unpaid balance is going to decrease and the line of credit is going to get bigger. So no matter if you're drawing funds or paying funds back, it's like a seesaw or a teeter-totter. They're always going to balance each other out. Keep in mind that both sides of the seesaw are growing every month at the same rate. So this 200,000 would be approximately 210,000 by the end of year one. Now, of course, most people aren't aware that when they make prepayments on a reverse mortgage, the loan amortizes the same way as a forward mortgage does. So if you were to make the same payments with the same interest rate over the same period of time, forward and reverse loan balances will drop the identical way. As you can see, the forward mortgage will eventually drop to zero and the loan will be paid off. So with a HECM though, however, you want to be careful because if you pay it down to zero, the line of credit would close. You always want to keep a minimum balance of at least $100 on there, or the lender will assume the borrower was trying to pay it off and they will close it out.
Time for a brain train. What are two functions of the HECM ARM lock that create growth? A, refinance or prepayments. B, purchase or refinance. C, purchase or organic growth. D, organic growth or prepayments.
Go ahead, post in the Q&A pod what the answer is, and we've got some going already. Again, we have an outstanding group. Everybody's got it right. It is D, organic growth or prepayments. Thank you.
Wonderful, wonderful, wonderful. So here is the prepayment waterfall, which I touched on earlier when I mentioned that some of the servicers get it wrong. So when we make prepayments, the mortgage note specifies how the payments are applied. We often refer to this as a servicing waterfall. First, the money is going to go to the portion that represents the mortgage insurance. Once that's paid off, second is going to go to the portion that represents servicing fees. Third, to the portion that represents accrued interest, and fourth, to the principal balance. Now, notice that the government always gets paid back first. No, that's the easiest way to remember that servicing waterfall. And by the way, any payments that exceed $600 for the year will show up on an IRS Form 1098 in January. This will show how much of the mortgage insurance and mortgage interest was paid the previous calendar year. Now, keep in mind that that's just for tax and accounting purposes only. The borrower will use that for their taxes. The investors don't, the investors care about it, but the line of credit doesn't care what part of the loan balance was paid back. That line of credit is going to grow. It's going to be a dollar for dollar exchange. Okay, so it's one thing for the line of credit to grow, but it's equally important to know what monthly payments it may be converted to at a later date and time when the borrower's traditional retirement funds are depleted. Is it expected to replace the homeowner's monthly retirement income at that time? So keep in mind that a 10-year payment is given to the homeowner every month for as long as they occupy the home and abide by the terms of the loan agreement. So using an example of a 62-year-old homeowner with a $450,000 home, the initial line of credit is $197,000. We can project the line of credit values as well as the monthly payments in which the line of credit could be converted to. So as you can see at closing, the homeowner could have a 10-year payment of $965 per month. However, if they waited until age 90, they could receive approximately $8,437 per month. So it's an important tool to understand when you're talking to financial advisors. Maybe you want to leave that money in the line of credit and take it at some point in the future. Or you could look at that strategy and say, okay, if we take $965 starting today and we take less out of the investments, they can change their investment projections for the borrower taking less. What does that look like at the end of the borrower's life expectancy? So the compliant explanation for the line of credit is that the growth is simply that. It is growth. It is not income. It is not interest. It is not earnings. It is not a return on your home equity investment. And it is not guaranteed to grow. So that I know I've told you this whole time that it's guaranteed to grow, but if the line of credit is at a zero balance, growth on zero is still zero. Okay. Same thing with if your borrower has passed away and there's a non-borrowing spouse remaining in the home on a deferral period, the line of credit will stop growing. So just wanted to point that out to you. Those are the two situations where the line of credit would not grow. And there are other things you could get into too, as far as if the borrower didn't pay their taxes and, you know, we had to pay them through loan proceeds, then we're taking money out and that line of, you know, it could not be growing because we're making a withdrawal. The best way to explain the line of credit is a greater capacity to borrow more money in the future, regardless of home value. So that's the best way to explain it. It's easy to understand and it is compliant. So you should all write that down. It's a greater capacity to borrow more money in the future, regardless of home value. Great way to explain it.
Time for a brain train. In what order do prepayments get applied for tax purposes? A, mortgage insurance, accrued interest, servicing fees, and principal balance. B, mortgage insurance, servicing fees, accrued interest, and principal balance. C, servicing fees, mortgage insurance, principal balance, and accrued interest. D, accrued interest, mortgage insurance, servicing fees, and principal balance.
Now, I know it was said very quickly, but what do you think? Wow. I am impressed. Everybody has been paying attention today.
Amazing.
Awesome.
But you know, this is a CRMP class. We usually get the cream of the crop on these. It doesn't surprise me.
And the answer is B, mortgage insurance, servicing fees, accrued interest, and principal balance. Thank you. So that is the end of today's call. We do have a couple of questions, Barb. The first question, on HECMs we did a few years ago, does FAR notify the borrowers that more money is available to them? If not, how do we find that out for them?
Well, Peter, thank you for asking your question. And your borrower is going to receive a statement for their reverse mortgage every month. And on that statement, it's going to show them the amount of the available line of credit. That will change as they make draws. It will increase organically. Of course, if they make a payment back, it's going to increase, but every month it's on their statement.
And would the $5,000 pay down, the example that you showed in the beginning, increase over time by the rate plus 0.5%?
Correct. So yes, that $5,000 prepay is going to increase that line of credit. And then the full amount of available line of credit is going to continue to grow at the current interest rate plus 0.5%. So yeah, making that $5,000 payment is worth way more than a $5,000 increase later on down the road, because that 5,000 is going to grow just like the rest of the line of credit.
Do we know if there's a line of credit video that they can share with their partners or clients and prospects?
Not that I know of. Chris, we could check with marketing on that. I know marketing does the consumer facing things.
Okay.
Well, maybe we'll check with marketing and see if they have anything.
Okay. So when a payment is made, isn't the MIP interest deducted and whatever is left is put against the balance?
So no, well, okay. So the way that it is posted for tax purposes is the MIP, it's the MIP, the servicing fee, if there is one, interest, and then principal balance. However, that is just for accounting purposes. It is a dollar for dollar return, regardless of where they post that to. You're decreasing your unpaid principal balance, and your credit line is the difference between the current principal limit and your unpaid principal balance. So it is increasing dollar for dollar.
And is the MI and interest added to the loan tax deductible?
So I am not an accountant, Gary. You should check with your accountant on that. What I've heard through the grapevine, which is not professional advice, is that interest and MI is deductible in the year in which it is paid. Therefore, if they make a prepayment, they would receive a 1098. If they choose not to pay it, then it's deductible in the year that it's paid, the year that the house is sold and everything's paid off. So hopefully that answered your question.
Does Elisa increase the line since it is sitting on the sideline?
No, so Jeff, the way that we calculate the LISA, we actually include the growth ahead of time. So when we decide how much is set aside at the beginning of the loan, the growth rate was considered.
And when I've made payments on my HECM, dollar for dollar has gone into my line of credit, but not against my unpaid balance. Are you saying that is incorrect?
So Anonymous, I would say you also had interest and MI that month. So that's probably going to be the difference. So you won't see it dollar for dollar in your UPB, your unpaid balance, because keep in mind that, let's say you owed 100,000, you paid 5,000 back, you would think that your balance would be 95,000. However, during that 30 days, you had interest in mortgage insurance that was added. So it would be 95,000 plus whatever interest and MI accrued that month.
And is growth rate given on funds assigned for term payments?
I'm going to assume that that is in the calculation. That is a good question. I think I'm going to have to think through and process that one in my mind for a minute, Chris. I know it's calculated for the tenure. Let's take that one away because my mind's going to need a minute to process through that.
Thank you. Any other questions? Please go ahead, post in the Q&A pod. And just a reminder, a day after today, you will get a copy of the recording. So if you missed anything, don't worry, you'll get a copy of that recording. Is any upfront MIP ever refunded to a borrower within the first few years?
Not that I have ever heard of, Chris. Have you?
No.
Okay.
If they do a HECM to HECM refinance, there's maybe a decrease in the MIP, but
right.
No
but
refunds.
Never any refund. No.
Awesome. Any other questions? Well, I want to thank Barb for being our instructor today. I want to thank everyone for joining today's call. And that question that we're taking away, we will make sure we get answered and sent out to everyone. We hope you enjoyed today's call and have a great day, everyone. Bye-bye.
Thank you.